Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we're following in the BNN Bloomberg newsroom. Shares of Scotiabank are moving higher, up about 2.4% right now after the lender topped profit and revenue estimates in its most recent quarter. The results were driven by better than expected performance in its capital markets and wealth management divisions. Scotia also forecasts faster growth next year in its core Canadian banking division. It now expects double-digit growth in profit. Shares of Laurentian Bank are surging today, up more than 18% right now after the lender announced it's selling itself in two parts. Fairstone Bank will buy Laurentian for $1.9 billion, $40.50 a share in cash. Separately, National Bank will acquire all of Laurentian's retail and small and medium business assets. Laurentian will exit retail banking to focus on commercial real estate lending. Eric Provost will remain as CEO. Shares of Shopify are trading up. They're up about 5.3 right now. Its merchants racked up $14 billion in Black Friday sales, a new record for the company. Shopify says merchants saw strong demand across apparel, home goods, and beauty products, with peak sales hitting more than $4 million per minute. Canada, the U.S., Germany, and Australia among the highest selling countries. Taking a look at the markets, TSX trying to bounce back after a loss yesterday, ended that rally they had going, but it's still in the red right now, off by 0.3%. South of the border, turnaround after an off day yesterday. You can see they're all in the green. S&P 500 up 0.13%, Dow Jones up by a quarter point, and the NASDAQ up by almost a half point. And as we mentioned, Laurentian Bank is up more than 18% after it announced a split sale to Fairstone and National Bank. For more on this and to break it all down, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, thanks as always for joining us. Yeah, there's some moving parts going on here.
There's some moving parts, and Laurentian Bank has been struggling for a while financially. So a lot of analysts saying that this is a really good day for Laurentian Bank, a really good day for shareholders of Laurentian, and that this bank really just couldn't compete when it comes to capital with the other banks we're seeing in Canada. And look, as you mentioned, Laurentian Bank up more than 18% today. So just skyrocketing. And we'll talk a little bit more about this deal specifically. Fairstone Bank is acquiring Laurentian for $1.9 billion in cash. This was announced today. And then as part of this deal, National Bank of Canada is buying the deposits and loans of Laurentian. Not the branches, not the employees. Those will not be transferred to National Bank if this deal does, in fact, go through. So this means all branches in Quebec will be closed when this deal is done, and there will be layoffs. And apparently those employees from Laurentian Bank who might be laid off here do have first dibs at any open positions within National Bank of Canada. But obviously there is a downside of this. Apparently the headquarters for Laurentian Bank, that head office staying in Montreal, the CEO staying on as well. But it is a really interesting deal. And as I mentioned, this still needs to be voted on. Laurentian shareholders need to vote 2/3 in favor of this deal. But a lot of analysts saying, too, like there's a 20% premium on the close yesterday for this. So it's hard to imagine that shareholders won't be in favor of this, particularly when you think about how Laurentian has been doing over the last couple of years.
All right. What's the reaction to National?
National Bank is reaching an all-time high today. When I checked earlier, it was at $169.77. So this is really good news for National Bank. A lot of analysts are saying that that's really the focus here, is the reaction to National Bank, not so much Laurentian. And you spoke actually with Rob Wessel earlier today, co-founder of Hamilton ETFs, and he was talking about how this is a great deal for National, right? Like it doesn't have to close any branches. It doesn't have to lay off any employees. It doesn't get that baggage from Laurentian, but it gets all the benefits. And that National Bank has been apparently outperforming for a couple of quarters now. So this is all just kind of a good news situation for National Bank. Here's more on what Wessel had to say.
I think this is a positive. Listen, this is a very well-run company. They have a very high ROE relative to the group, for example, in contrast to Scotia, which reported today as a much, much lower ROE. And, they've had very strong earnings growth. It's a very, very well-managed company. And so this is yet another example of strong management taking opportunities. Even if it's not a huge transaction, they still manage to, it looks like, they'll get some ROE accretions out of it, which is very good for a bank that already has a much higher ROE than the average, them and Royal. And the fact it picks up 2% of EPS is also worth noting.
And so according to Bloomberg Intelligence, this is expected to add about 1.5 to 2% to earnings per share for National Bank. It also adds $4 billion of loans, $8 billion of deposits. So a good day for National Bank as well. And then, of course, we just have to wait to see whether this vote actually goes through.
Okay, Lindsay, thank you for
Thanks.
that. BNN Bloomberg's Lindsay Biscaya. For more on the Laurentian Bank deal, we have Eric Provost, the president and CEO of Laurentian Bank, on the close this afternoon. The interview will take place at 3:40 Eastern Time with Morella Fernandez. And up next, we're talking to Martin Peltier about Scotiabank earnings and what analysts want to see moving forward. Stay tuned. And we are continuing our coverage of Scotiabank earnings with Martin Peltier, the Senior Portfolio Manager from Wellington Altus Private Counsel, joining us now to talk more about it. And thank you very much, Martin, as always, for joining us. Initial reaction to the numbers?
Fantastic. And it delivered a strong quarter. Beat analysts' expectations, despite one-time restructuring charges. Earnings came in quite strong. Revenue was up 50% year over year. A nice increase in net interest income and a nice increase in non-interest income. So really nothing to complain about.
Where does this leave investors then when they look at Scotiabank? Does it ease fears that they were overvalued? The banks are overvalued? Where do we see this heading for the week with earnings coming from the other banks?
Okay, so I think that the big question is are we going to see continued broader market strength? Because that's what's driving the banks here. Robust trading, business banking, wealth management, very strong mutual fund and brokerage revenues and trading revenues from the iBanking side. Retail, not so much. It's been okay. So those banks that have larger wealth management divisions, larger iBanking are going to continue to do well. The big question is that in valuations already? If you look at where they're trading at as a whole, the banks are at 13 times forward earnings. On the surface, that looks okay, but that's about a 25% above their longer-term averages. And so the big question is can they continue to deliver on that growth? Because the dividends yields aren't as strong as certainly as they were at the beginning of the year. So you're going to need to make up that the return potential from the growth, and that's going to depend on the broader market continuing to show that strength in 2026.
All right, now I bring it back to Scotiabank. Their provisions for credit loss trend, how did that look?
Yeah, I mean, everything looked okay. There was really no surprises there. The bank is doing some changes internally, and they're making progress there. Hopefully, it can narrow the gap between it and the other banks. It's been lagging on performance this year. I think it's up 26% this year compared to CIBC or TD that are up. CIBC's up 37% and TD's up 50%. So there's a little bit of stock picking differences in performance in those names. And Scotiabank's certainly making the right necessary changes to narrow that gap.
And under Scott Thompson, does it look like that overhaul isn't working?
Yeah, it does. I mean, we don't own it. We own more of the basket of the names. We tend to lean more towards the TD and Royal Bank. Royal Bank hasn't performed as well this year, but offset by the strong strength in TD. Jefferies came out with a report saying are these things priced to perfection, and that's the big question. Is the continuing changes at Scotia going to continue to generate the narrowing of its performance gap to its peers, and are the peers in general going to continue to show some strength?
And do you think we'll see more cutting? We saw some in Canada with them. Do you think we'll see more of that?
Yeah, especially maybe on the retail side, retail banking side. The broader Canadian economy is not on a sound footing. Bank of Canada has done a good job of being proactive and cutting interest rates, certainly a lot more so than the Federal Reserve. And now the Federal Reserve, hopefully maybe we'll see a rate cut that'll ease some pressure on the Bank of Canada in regards to the currency, because we don't want the currency to fall too far. But Retail banking, I think there is a risk for the Canadian economy next year, and those with greater exposure to retail lending and retail banking within Canada are going to exhibit some weakness there, and hopefully that could be made up through continued growth in the other segments I just talked about.
Okay, I want to get to some stocks you want your clients to watch for. We'll stay on the banks just for first one. BMO, what do you like about it?
Okay, so looking at the sector in general, saying top down, I like the banks as a basket, and looking at them heading into the new year, I would probably look at trimming some of that back or look at doing covered calls on some good on these banks. It could be Bank of Montreal, as you had mentioned, or Royal Bank, or TD. Bank of Montreal, I really like their wealth management division, BMO Global Asset Management, outstanding department run by some really good people over there. And I like the growth that they've had within their wealth management side on the asset management division.
And I also read that in a hurry. You like BMO ZWB.
Yes.
Sorry about that.
Where I'm going with this
it was a quick glance.
Yeah, no, that's okay. And doing the BMO, that's part of their asset management division is the ZWB, which is a covered call on the basket of names. It's yielding at 6%, so you're getting that extra dividend boost from the covered call space. And so if you're going to continue to own that space, the BMO ZWB ETFs is a good one to own. And then I would be looking at maybe trimming back some of the bank positions and going into some other segments in the Canadian market next year.
Okay, and a couple of those you're looking at, Enbridge is another one?
Yeah, Enbridge, it's only up 11% this year. It's kind of boring. Nice dividend yield, 5.6%. It'll have a little bit of growth, maybe 3% growth. Now, if you can bang out 10% a year on an Enbridge, and given where GIC rates are at and a nice dividend yield, I think that's a good stock to own. We do own it. And TELUS, we've been buying TELUS on the tax loss selling here, down at 18%. I know, $18. It's down 8% this year. Dividend yields over 9%. People think that they're going to be a dividend cut like Bell, your parent company, BCE. But if you look at the DRIP, it is able to, as long as that DRIP continues, to pay out that really nice juicy 9%. And I think it'll have a nice recovery following this tax loss selling season here. So we've been buying a little bit of that on the dip.
Okay, we'll wrap it up there, Martin. Thanks as always for joining us.
You betcha. Take care. Have a good day.
Martin Pelche is Senior Portfolio Manager from Wellington Altus Private Counsel. Earlier today, we sat down with the Fine Art Group's President of the Americas, Anita Harriet, and we discussed the pitfalls of art investing, also the benefits. We'll have that conversation next. In art, many people love art for art's sake, but also it can be an investment, but it can be a risky investment if you don't make the right decisions about it. We sat down earlier with the Fine Art Group's President of the Americas, Anita Harriet, and discussed the pitfalls and pros of art investing and how to make an informed decision.
We're asked all the time by ultra wealthy clients, I'm interested in diversifying my portfolio. Art is an interesting investment. It's semi-liquid. You can park, if you're buying the right thing, you can park your money there. It can sit there. It doesn't fluctuate the way we see, stocks fluctuate. So they'll say, like, what percentage of my portfolio should be in these assets? And this brings me to the clip. I'll get there, I promise. And, typically, we don't like to see clients exceed more than 4% of their, overall wealth portfolio in art investment. Now, that can fluctuate up or down depending on a client's real passion for that asset. But so to give you a sense, if someone's spending over $200 million in an artwork, note that means, their true wealth is, tremendously higher if, it's somewhere below 10% of their, portfolio. So, we did see what is pretty interesting is that kind of post 2009, when we saw the market just crash and we thought, oh, who's going to buy a piece of art? Nobody. What we actually saw was an incredible increase in the acquisition of these artist assets, and primarily coming from countries that hadn't traditionally kind of gotten involved in these kinds of acquisitions. China, Taiwan, Russia at the time, not now, Brazil, India, Middle East. So what we've seen over the last 20 years is a real entrance in the marketplace of ultra high net worth clients that are really interested in acquiring these works for a variety of different reasons. Everything from showing kind of nonverbal ways of communicating power, right? You walk into a house and you see a Klimt.
You're going to go,
there's something important going on.
It's not that print I have from MoMA. What kind of a return does art offer? And I mean, for the people who aren't the ultra wealthy, can you invest in it? Are there ways to look at art as an investment?
Of course. But like any investment, whether you're buying a stock or buying a piece of real estate or doing forensics on a business, it's all about the due diligence. So of course you can acquire artwork as an asset. But when you look at an asset, you're thinking ROI, right? Mm-hmm. And I have a lot of clients, we have a huge advisory business, meaning we help clients buy, and clients will say, hey, I'd like to buy art. Great. And then I say, all right, are you okay with taking $100,000 in one bucket and putting it in another and having it worth zero? And they're always like, no, I don't want that. And I'm like, well, that's called a decorative acquisition, right? It has nothing to do with ROI. It has nothing to do with investment. But if you don't do your due diligence, that can happen. And they're like, well, no, I don't want that. And I say, well, if you have $100,000 in one bucket, you put in another, do you want it still to be worth $100,000? I'm like, yeah, I want that. And that's financial preservation. So you can buy art to hold its value, but there are kind of 9 categories of analysis we use to determine value. And if any of those is a D or an F rated, you could have something that is not a good acquisition. The third kind of client says, I have money in one bucket, I want to put it in another. Is it, are you looking for ROI? And that is a completely different methodology you utilize when you're looking for ROI than you would for financial preservation.
Okay, I want to bring Rob in for a second, who's our guest co-host this morning. Rob, you have a question for Anita.
Yeah, I was just curious is if you think of art and you use the analogy of the stock market, are there parts of art that are kind of have higher growth potential and maybe higher risk? And are there parts of art that have maybe more stable returns and have a more predictable outcome for those more conservative art investors?
Terrific question. I love the way you asked it. Yeah, so we have what's called kind of blue chip art, and blue chip art's like a blue chip stock, right? It's steady Eddie. And these are typically artists that kind of change the way we look at art history, right? They're like catalysts of change, watershed moments in art history. So think Monet, think Picasso, right? Think Basquiat. And again, you could buy terrible Monets and terrible Basquiat. So again, that due diligence is still really, really important. But if you acquire them, it's like you can park your money there and to buy a good one at a good price, and it's a solid investment. Will it grow exponentially? No, but it will hold its value. But then there's a whole group of artists, and we saw this specifically when the market was out of control, especially around from 2015 to 2022 with a little COVID in between. We saw people investing in living artists that those categories of analysis we use don't apply necessarily. And these are artists that are acquired by significant galleries, but they didn't change the way we look at art history, right? They're risky acquisitions, but what we see is a lot of flipping of these artworks. They spike high, they go low, and a few of them hold their value over time. And when clients say like, hey, I want to buy new artists, I'm really interested in, buying and selling. And I'm like, well, great. Do you like penny stocks? I'm like, what? So it's the same. There's no difference. But there are additional levels of due diligence we do when clients do want to buy living artists who don't have strong, long careers.
Can you have any emotion in this, or if you're looking to buy stuff, do you have to actually just remove all emotion from it? I mean, because in the end, some of the stuff you'll actually have hanging on your wall, and it's still an investment. Can you have any emotion when you're investing in art?
Well, my job is to take the emotion out, right? I'm like a robot, and that's what I need to do for my clients, because I don't want them in an auction house bidding, right? The thing about auction is it works when you have two bidders who are psychologically connected to the experience, right? That's all you need are two bidders. So our job is to kind of get in front of that, determine value, and basically set a baseline for what's appropriate in the market. However, a lot of people who collect art and wine and other assets and jewelry, it's experiential, right? You can still live with your art, which is one of the great things about the investment, right? Mm-hmm. I have artwork right behind me. So it is experiential. You can have passion, but you really do need to have an unemotional side to that process. And that's why, it's important to work with someone who knows what they're doing.
And that was Anita Harriott, president of the Americas at the Fine Art Group. Vancouver's November housing data is out. We will have more on that. The numbers aren't too good after the break. The global economy is forecast to grow this year in its upgraded outlook. The Organization for Economic Cooperation and Development says the world economy is expected to grow 3.2%, an improvement on the 2.9% it predicted in June. The OECD is also raising its forecast for U.S. growth this year to 2%. The organization says despite concerns about a sharper slowdown amid higher trade barriers and significant policy uncertainty, the global economy has shown resilience. Vale Base Metals has signed an agreement with Glencore Canada to jointly evaluate a potential copper development project at their adjacent properties near Sudbury, Ontario. If it all works out, Vale and Glencore intend to transition to a joint venture as equal partners in the project. The agreement involves working out of existing infrastructure at Glencore's mine in that area. Greater Vancouver realtors say there were around 1,800 home sales in the region last month, down 15% from November of the past year, 20% below the 10-year seasonal average. The composite benchmark price for all residential properties was a little over $1 million, down 4% from this time last year, and 0.3% lower than October. Taking a look at the markets, the TSX still in the red, second day in a row after that nice little rally. It's up by 0.34%. The banks, though, most of them are up right now. But taking a look south of the border at the U.S. markets, everybody in the green there. Not by much, but they're up. The S&P 500 by 0.15, 16. Dow Jones 0.14. And the NASDAQ up by more than half a point. U.S. tariffs have taken a toll on Canada's steel industry, specifically Ontario's Algoma Steel. It has had to make the difficult decision to lay off almost half its workforce. CTV's Abigail Beeman has the latest in this report.
1,000 layoff notices at Algoma Steel, more than a third of its 2,700 workers in Sault Ste. Marie.
It's very devastating when you live in a community that doesn't have a lot of job opportunities and you're finding out that your job is going to end.
In a statement, the company blamed American tariffs. As a result of these pressures, Algoma has been forced to conclude its long history as an integrated steel manufacturer and close its blast furnace and coke-making operations in early 2026. Algoma will transition to electric arc furnace steelmaking at that time, a year earlier than previously anticipated or planned.
Moving away from the older blast furnaces to new electric furnaces, really as an environmental thing, that's a good thing to happen. Now they're having to do that with a gun in their head because of the tariffs.
In September, the federal government gave Algoma a $400 million loan, the province $100 million.
Our thoughts are with them. The Prime Minister looked them in the eye and promised he would protect their jobs.
My team and I have been in contact with Algoma's leadership team. We absolutely have every confidence in the Algoma workers as they're going through this hardship, and we will make sure that we support them.
The union says the government offered money without proper conditions to protect workers.
This city cannot provide employment for 900 additional job seekers.
To help those workers, the city's mayor wants to push other local projects like a deep sea port.
We're going to make sure that those files are in front of the Premier's office, in front of the Prime Minister's office.
Ontario says it's launching a local centre to help impacted workers, including retraining. The layoffs take effect in March of next year.
And that was CTV's Abigail Beeman. Vancouver's November home sales were down 15.4% on a year-over-year basis, a continuation of housing trends we saw in October. For more now, we're joined by Andrew List, Chief Economist and Vice President of Analytics at the Greater Vancouver Realtors. And thank you very much, Andrew, for joining us.
Oh, you're more than welcome. Anytime. Thanks.
Some difficult numbers there. That's quite the drop.
Yeah, it seems like that way. It is, again, a continuation of what we saw last month. You know, there's this pattern of being below our seasonal average is pretty usual at this point, actually. If we go back all the way to about 2022 is where we started seeing that sales really weren't as strong as they had been in previous years. And so we're really in a market that's going through a bit of a transition period from a time where we had really, really low interest rates in and around the pandemic to one that saw really, really high interest rates very quickly, and now coming out of that into what we might consider something a little bit more normal from a historical perspective.
Now, is it the interest rates that have been the factor, or are there other concerns for buyers?
Yeah, it's a certainly good question. You know, on the interest rate front, what we've seen is a few rate cuts this year. And so generally speaking, most economists would agree that rate cuts tend to translate into an increase in demand. And we did see a little blip of that here in the earlier part of the year on a couple of the cuts, but then that sort of fizzled out. And so, you know, the other part of the story is obviously this significant uncertainty that's come across, you know, in the just general economy as a result of all these tariffs and so on that have been announced in the United States. Now, they haven't necessarily had a real impact on BC's market in terms of, you know, unemployment rates and things like that, not in any majorly significant ways that we would typically associate with sales being down as much as they are. So it really seems like it's more of a mood shift amongst buyers and things here in the region. And we've seen this actually across Canada in some of the larger markets that have higher priced properties. These are the markets that are seeing sales slow down a lot more. In markets where, you know, prices have moved a lot less and tend to go up a lot more modestly at a grinding pace upwards and are a lot less volatile, if you will, those markets have actually been performing quite well across Canada. So it's a mixed bag, and it's really these regions that were typically more expensive that are seeing this sluggishness in sales.
And how many houses and condos are we seeing on the market right now? Is that staying fairly steady, or are people just holding on because maybe they bought at a different time and they're like, we need our money back, but they're not getting those offers?
Well, it's always hard to say what the motivations are for most people. I mean, generally speaking, most people move for life reasons and so on. And so, you know, it's hard to speculate on that. But in terms of the inventory trends, we are certainly in a time of elevated inventory. Now, again, I wouldn't call that a worrisome trend by any stretch of the imagination. Really, it's coming back to what I would call a more normal market. The market here in Vancouver is one that has traditionally been sort of starved of inventory. And it's why we've got many of those periods of time where prices have risen really quickly and things like that. So that, you know, right now we're in what I would describe as a much healthier environment in terms of the inventory side and even on the rate side. But the missing piece here to our market is really the demand that we would typically expect to see come along with those kinds of market conditions.
And now when it comes to the sales to active listings ratio, it's at about 12.6%. And when you get below 12, you start getting into some downward pressure. Are we seeing housing prices drop?
Yeah, so from a technical perspective, actually a bunch of the markets are what we call balanced conditions. But even in balanced conditions, you can have the situation of prices sort of moving down, drifting lower. It really depends on you know, the amount of demand that you have in the market and so on. So right now, it's towards the lower end of that balanced condition mark, really just at that cutoff of where we would call it a buyer's market. And so, yeah, over the course of the year, we've seen prices come down about 4% since the beginning of the year across most market segments. And again, you know, that would be the kind of thing you would typically associate with buyers wanting to step into the market as prices come down. It improves affordability, and we've had, you know, rates come down as well, but we're just not seeing it this year. So it may be a 2026 story of a bit of a turnaround. We'll have to see.
And is there one sector or one area being hit harder than others, like condos, Richmond, Surrey, downtown Vancouver?
Yeah, so I mean, to kind of keep it short for the purposes of this. I mean, generally the market is following similar patterns, across most market segments. There are going to be some deviations depending on the market segment you're looking at, but generally these trends that I'm talking about are the broad-based trends that you'll find in almost every region, in almost every segment. With that said, it is really the higher price point segments of the market which are seeing, more sluggishness in sales. And again, that really just comes down to that sentiment shift that we've had where, buyers just don't seem to be in the mood to purchase expensive properties at this particular point in time.
Okay, Andrew, thank you very much for joining us.
Oh, you're more than welcome. Anytime. Thank you.
Andrew, this is Chief Economist, VP Analytics at Greater Vancouver Realtors. Coming up, David Risher, CEO of Lyft, joins us on his new donation initiative and life in the rideshare area. That's next. Lyft CEO David Risher is giving back this holiday season. He joins us now on his new donation initiative, Growth Outlook for the Company, and what makes his company different from the competitors. And David, thank you very much for joining us today. We appreciate it.
It's great to be here.
Now, we're going to talk Roundup in just a sec, but we've got to talk a little business first. 2026 is rapidly approaching. Competition in this sector, fierce. You're trying to catch Uber. What plans do you have for Lyft to make inroads there and fend off some of the competitions that's coming your way?
What's interesting is as much as the other guys are obviously relevant in the rideshare space, I think more of all the people who are driving their own car or even maybe sitting at home, not even getting out and really wanting them to get out and experience, the best of life. I mean, our whole focus on Lyft is customer obsession is what drives our profitable growth. And we've been super obsessed with customers. We've got great drivers on the platform. We've got great riders on the platform all across Canada. We've actually doubled our presence in Canada over the last year. So a lot of wind at our back, just sort of making things good for us.
And how are you drawing them in? What are you doing that you doubled your numbers in the last while?
Yeah, some of it's through partnerships. For example, we have a big new partnership with United Airlines, which is a wonderful partnership. It allows you to get miles on United every time you take a Lyft. We've got a partnership with DoorDash in the United States. Hopefully we'll get that in Canada fairly soon as well. So that's a big part of it. And then a huge piece of it is just doing the basics right. Like, check both apps. And I always encourage people, check both apps, see who's got the best pricing, see who's got the fastest pickup time. And we think more often than not, that's going to be us.
And so with that, what about talk about autonomous? We're seeing that more and more now. Yeah. Where does Lyft fit in? Where do you see yourself fitting in with that? We could see it coming sooner than rather later. Sometimes it feels like.
You know what? It's so interesting. So autonomous cars, self-driving cars, for years and years, they were sort of a science fiction pipe dream. But really, over the last couple of years, they've really come into focus. And certainly if you visited San Francisco, for example, where I live, you'll see them all over the place. They're almost hard not to see at this point. So what does that mean for riders? What it means is you're going to have new choices on platforms like Lyft. We've got a great partnership with Waymo, who's really the market leader in the United States. We have a great partnership with Baidu, who's one of China's leading AV tech providers. That's going to be our main partner in Europe. And what you'll be able to do on the Lyft platform is be able to open up and choose to get an autonomous car, a self-driving car. Now, why might you like that? You might like it because they tend to be very reliable. They're quite safe. Frankly, robots are safer than humans when it comes to driving. And so they add a new, kind of dimension in the marketplace. But the other thing I would say is that's still kind of science fiction in the future for most people. We're going to be building what we call a hybrid network, which will have some self-driving cars, but still the majority, driver-driven cars for many, many years to come.
And with your drivers, how are you keeping them? How do you do retention? If they're looking at that going, we may be replaced by, actually just an empty spot in the seat. How do you retain them? What are you doing to try and keep your drivers happy?
Sure. I think it's a very real issue for us to be concerned about it. But I also think this will take many, many, many years before anything like even 10% of our business being, driven autonomously would be a huge, huge success. And that's over the next 5 years. But the thing that we're doing for drivers, we do a couple of things. We guarantee their pay in all kinds of ways, particularly around what we call a minimum earnings guarantee, where they'll always earn 70% or more of what a rider pays after fees. That's really important for a lot of drivers. And we've got a great driver loyalty program that helps drivers with things like discounts on gasoline, and other things like that. And that's been an incredibly successful program as well. We now have a 27-point advantage among drivers that drive for both us and the other guys in terms of preference. So that's wonderful. It really shows that what we're doing is resonating with drivers.
And okay, let's turn over to Roundup. Let's talk a little Christmas spirit and donating. Tell us a little bit more about that, the program.
It's such a great program. You've probably experienced this yourself, maybe on Lyft or maybe in a supermarket where you go and you'll be asked to round up your change. If it's $7.20, round up that 80 cents and give it to a nonprofit. We've got a great list of nonprofits that you can donate to. The Canadian Red Cross is one. True Patriot Love Foundation is another. Food Banks of Canada is another. In Montreal, we're working with Rue des Femmes and Maison du Père and a couple of other local nonprofits. In all, since the program was started in 2017, Lyft riders have donated over $42 million US dollars to charity. And this Roundup and Donut today, because of Giving Tuesday, I'm personally matching every gift as well as Lyft. So donations get double matched today.
And incredible, thank you for doing that. And the charities, I imagine, are very happy for you doing that. Can people choose? You mentioned all those different charities. Do you get to choose, or does it kind of go into a pot and then and then you'll decide where the money's going?
No, you get to choose. You get to choose. If you go to your profile and literally, go to the word donate, you'll see a whole list of charities you can give to. And remember, once you lock it in, you can keep it on for as long or as little as you want to, and you can always change nonprofits to focus your funding towards.
And what kind of a response have you been getting from people through over the last 2017? You said it started, right?
Yeah, as I say, it's been about $42 million that people have given. We're talking about hundreds of thousands of people who use the program every single year. But frankly, hundreds of thousands of people, given that we have over 50 million riders, is just too small. So, I want to double it and double it again. That's why, again, I'm doing this personal match today to try to encourage as many people as possible to give. And remember, you're talking about small amounts of money individually, 20, 30, 40 cents a ride, but it adds up. As I say, $42 million is not nothing over 7 years.
No, it's not chump change. David, thank you very much for joining us and with that initiative. We appreciate it.
That was a real pleasure. Thanks so much for all your great questions.
David Risher is CEO of Lyft. Still ahead, today's market movers with Bloomberg's Matthew Griffin. All right, let's see some of the movers south of the border. We're joined now by Bloomberg Equities reporter Matthew Griffin. Matthew, thank you as always for joining us. We're talking about Boeing on the rise. Its opposition, its competition had a little bit of a rough week there, of course, Airbus. But Boeing, CFO, they said they expect a positive free cash flow. Some good news.
Yes, Roger, thanks for having me. And investors are welcoming this update from Boeing CFO Jay Malave. This milestone of turning positive on free cash flow is a pretty significant one when it comes to the turnaround efforts at Boeing. They've burned tens of billions of dollars in recent years as they more or less lurched from crisis to crisis. You had the aftermath of the 737 MAX crashes. You had the blowout of a panel in the middle of a flight. You had a crippling strike last year. So for them to return to generating positive cash, that would be the first time since 2023, a real positive for investors. Jay Malave also said at the UBS conference where he made these remarks that a long-term goal of $10 billion of cash generation is still on the table. That was something that was supposed to happen this year, got pushed out because of the challenges that Boeing has faced. So the shares have come down a little bit recently. You had the delay of the 777X jet, some general weakness in the market, but investors greeting this as a positive sign. Shares up as much as 9.6% today. That's the most in one day since April 9th.
I was just reading his comment. I'm very comfortable saying that we can absolutely deliver $10 billion. That's it's pretty gutsy to lay that out on the table like that.
Yes, and if you look at Boeing stock, their shares are still well off where they traded before the panel blew off the plane in midair. They closed at $249 before that, now just above $200, and they're even further off where they closed before the COVID pandemic, the 737 MAX aftermath. So investors maybe don't feel quite that same level of confidence as management is professing, but we'll see where that narrative goes from here and where the stock goes.
All right, a little competition with Airbus after what's been going on. Good to see between the two of them. Okay, let's move on. XPO, the trucker, seeing some November results, not quite up to snuff.
Yes, shares here down more than 8% today after XPO said that their less than truckload tons per day fell 5.4% last month. Now, that metric's a bit of a mouthful, but basically a measure of how many goods they're shipping each day. Not what investors were looking for here. Truckers have been under pressure all year. They were facing soft demand coming into the year. Then you pile tariffs on top of that. It's a tax on the very goods that they're shipping. XPO actually been one of the better performing stocks, but has taken a big hit today, now hovering around flat on the year since this update. So maybe put them back in the category of truckers facing a bit of a challenge. There was a positive update from Saia, one of their peer companies today. Their shares are up. So I guess we'll see what investors take away from all of these reports we're getting and whether they see more challenges to come for the sector.
Okay, and last one, MongoDB, Freudian slip there. MongoDB's report, how are investors responding to it?
They are responding really well. Shares up more than 20% today, bringing a year-to-date rally to about 75%. They reported profit, adjusted EPS, that beat estimates for the third quarter and gave a strong outlook for the fourth quarter. They see adjusted earnings per share as much as $1.48 US. Analysts were only looking for 95 cents there. So this is a company that they're in database software. They facing strong competition, had some rocky quarters. Shares slid last year, but they've now just about clawed back from that hole. And so we're seeing a lot of optimism among investors. Barclays puts it pretty simply. They say this is a sign that the company is back on track.
Perfect. Matthew, thank you as always, sir.
Thanks for having me.
Bloomberg's Matthew Griffin. New Brunswickers won't be seeing cheaper costs at the gas pump anytime soon, despite the promise by New Brunswick Premier Susan Holt. CTV's Sarah Plowman has more.
Prices at the pumps didn't drop today, despite a promise by the Premier.
It's easy to promise, it's harder to deliver.
I don't know what choice we have, really, right?
New Brunswick passed legislation to scrap a carbon surcharge on fuel prices. An extra 8 cents a liter passed on by refineries and retailers to cover the cost of federal environmental regulations. But 3 days before gas was to go down, the province's energy regulator canceled the cuts and sided with retailers and wholesalers by bringing in a temporary charge equal to what Premier Holt removed. The result? Fuel prices stay the same for now.
Yes, I'm quite frustrated by it because it's clear that New Brunswickers have been overcharged. We wanted to take that pressure off of them. It's been clear that the formula doesn't accurately cover costs that haven't been proven.
The provincial opposition claims the Premier misled the public.
I think she's got to come clean. She's got to tell New Brunswickers that she overpromised last fall.
Industry has argued New Brunswick's plan would threaten a quarter of the gas stations in the province.
We would have expected to see service stations not being able to survive without that margin.
The manager of this gas station says businesses like this one could not have absorbed the cost.
The big companies might be able to handle it, but the smaller ones, no way.
Premier Holt says she's looking at what the options are between now and February, when a final decision by the board is expected.
And that was CTV's Sarah Plowman. And that just about wraps things up for this edition of Trading Day. We take a quick look at the boards before we go and see how things are doing. Heading into the back end of the afternoon, you can see the TSX Composite still in the red, struggling for the second day, off by 0.35%. S&P 500, it is up, and the NASDAQ as well is up 0.55. Have a great day.